Hello everyone. So welcome back again to yet another video in our value investing series. Now you would be wondering why I have come in person for this video, because normally my subscribers or who are watching my videos in the YouTube channel, the value investing series, you would be knowing that I normally do a podcast transmission, which is like I will not be coming directly to the video, but I'll be speaking in an audio mode and I would be presenting my slides to you to explain about various concepts. So this time the topic is very vital, and I feel that many of my subscribers or even my viewers, or in that case the investors also, are so much skeptical and has got a lot of confusions regarding the topic recession. So many a times people have only read about recession and have never came across such an event. So as you know, previously we have come across COVID, which is in 2020, and now in 2022 people are talking about recession. So the topic recession, I'll be presenting it here, and I will try to cover all the aspects related to recession. So investors, especially those which are very new to the market, very new in the sense who have entered the market say in past 5 years, they are very much skeptical and speculative about this recession. So they are confused what they have to do with their investments and how to go about it. So once again, I am here to handhold you through your investing journey, especially during this confusing period of investments. So in this session, I intend to share to you the following topics. The first one, obviously, what is a recession? Secondly, what has caused this recession in 2022? Third one, is it really a recession now? And fourth one, should you be really bothered about this inflationary period and a period of recession thereafter? And fifth point, how will this inflationary period and a recession thereafter affect your investments? And the final one will be what you should be doing with your investments. Here, as you already know, the subject we talk about is mainly stocks, equity portfolio. So I will try to share you what you have to do with your equity portfolio and what all corrective actions. Should you be selling your stock? Should you be buying into new stocks? Or should you be averaging your stock portfolio? Or should you remain in cash? So all these things will be in detail discussing in this video. As you already know, my videos remain unbiased and cuts all the unwanted noises in the market, and all my viewpoints are based on pure fundamental analysis. So let's get straight into the topic, recession. So what is a recession? So it's a period of economic slowdown, or you can call it a sluggishness in the economy, for a particular period of time for a particular region. So that's a recession. So recession is technically identified by a consecutive fall in the GDP quarter on quarter, like the last quarter and the current quarter. So 3 months plus 3 months. So if a country has a GDP continuously falling for 2 quarters, then technically the country enters recession. So this fall in GDP is also normally termed in the market as negative GDP growth. So negative in the sense it's not minus, it will be a figure, it can be a positive figure only, but compared to the previous quarter, the GDP would have grown low. An example to state, like in the last quarter, if the GDP growth was 5%, and in the current quarter, the GDP growth dropped to say 4.5%, and in the next quarter, say the GDP growth has further fallen to 4%. So from 5, it has fallen to 4.5 and then to 4. So it's called a negative GDP growth. So this technically qualifies a country to be entering a recession. So this period normally is identified by a great drop in unemployment, like people lose jobs. Again, we'll explain why the people lose job during this period of recession. And there will be economic sluggishness, there will be lack of real income or reduced real income, there will be loss or dip in industrial production, and even there will be dip in retail sales. The National Bureau of Economic Research, NBER, is the group of academic people who actually identifies whether it's a recession in US or not. So US being the mother market, because there are heavy investors from US to all other various countries. So if anything happens to the US market, it is obvious that the other markets also get affected, or the other countries also get affected, and similar events happen in the other countries as well. NBER not only looks into the quarter on quarter data, but every month data is also equally analyzed as far as the GDP is concerned for declaring a recession. So the shortest ever recession period in the history is during the COVID pandemic time, which is in 2020. In March and April 2020 was the period of short-term 2 months recession. So this was during the COVID pandemic had hit heavily in all the countries. So we had a recession at that time. So during this economic recession, the economy contracts. Recession normally occurs at the end of a expansion. So economy expands, then it contracts, just like a business. So that's a normal cycle. So recession is a period wherein the economy contracts. Well-known example of recession is in 2008 financial crisis. A depression is a deep and long-lasting recession. Depression is also a type of recession, but if the recession is very long or it is so much deep, then it's called a depression. It can last for several many years. Great Depression of 1930 is a great example to state. Now let's move on to the second topic of this session. What causes recession? So recession, if you ask me, there is nothing to be worried about. So it is part and parcel of an economy. A normal business cycle expands and contracts, as you already know if you are a business owner. So as a business expands and contracts based on various factors, our economy also expands and contracts. So as I mentioned earlier, if an economy expands, there is boom in the market, there is a lot of people coming in to invest, and once the investments are very high and things go wrong, then there will be a contraction, and that is a period of recession. So as I mentioned, recession is completely normal and healthy for an economy. So in an economic expansion, there is a fast rate of growth in the economy. So there are a lot of lenders available for the borrowers to borrow, like loan. So loan is like, I want to run a business. So I want to grow my business exponentially. And if I don't have the entire capital for that, I will definitely go for a borrowing, which is debt. So I will be borrowing it at an interest rate. There are a lot of lenders available, and if the interest rates are low, I can borrow more and try to run my business. During this period of expansion, even the loan is cheaper because the interest rates are very low. So people borrow and spend on products and services. So during this period, the debt levels go so high, and so is the spending. Asset values rise so rapidly, and later this asset bubble burst since the debt level rise so high and it cannot be serviced anymore. Even economic shocks like COVID, like times of pandemic, can also cause a recession, as we have seen in 2020. So again, coming back to our topic, what caused recession in this 2022, which currently we are facing? As you all know, in 2020, once the pandemic, which is the COVID, hit us, there was total economic sluggishness. There was less spending. People were so much worried. They were not getting out of the house. There was very less productivity. So to push the economy, government had brought in lot of stimulus packs. So like bringing in liquidity into the market to promote spending, they had injected a lot of stimulus packs. Even the interest rates were very low at that time, so that people can borrow easily and spend, and spending creates push in the economy and the economy grows. But as this spending is promoted by the debt, everything is serviced by credit, which is caused by borrowing through debt. So all the governments, not only India but even US, UK, everyone was injecting lot of stimulus pack into the economy so that liquidity will boost and push the economy up. But what has happened is that the liquidity was so much into the economy that people were spending like anything. The asset prices increased. So again, as I explained in earlier videos how economy works, this spending and lot of credit formation and lot of debt levels led to high levels of inflation, which we are currently facing. So post the COVID, like post the COVID in the sense that the critical part of COVID, I feel it is over. So I will call that post the COVID. The economy revived like anything. So you can see the stock market also gaining so much from a very low levels in 2020 to 2021 end or 2022 starting. And this again led to increase in price of commodities and products and services, and again this led to high levels of inflation. If you see, commodities like crude oil has touched a high level of almost $135 per barrel. This inflationary effect is not only because of this high liquidity which was injected during the COVID times, but also there is another main factor, which is Russia-Ukraine war. Though this Russia-Ukraine war has not solely contributed to the inflation, this definitely has contributed some part of it for a high inflationary levels. So as the war intensified between Russia and Ukraine, and also there are various aspects of this, so I will not go into the Russia-Ukraine war. Maybe I will try to put another video on this. So as the war intensified, the Russia cut a lot of exports like crude oil and other products to the Europe and other countries. This led to shortage of commodities like crude oil. So this shortage led to demand in the market, and as you already know, demand and supply game. So if the demand increases and if the supply is not there, then the price levels increase. So this is a pure case of inflation, which is the price of commodities and other things increases. So again, coming back to the post period of COVID pandemic. So at this time, as the interest rates were very low, people were borrowing like anything. There was lot of spending. Though there was spending, there was very least productivity, because spending is mainly backed by borrowings but not by the real income. Borrowing, as you know, will help to spend more than what is been actually produced. So lesser productivity means lesser job requirement, so higher unemployment. Higher unemployment, or in that sense less employment, means lesser people getting salary. So lesser salary means lesser spending. So lesser spending again means people are not buying much, so there is lesser productivity. So it's a vicious cycle. So lesser productivity means as the country's productivity decreases, the gross domestic production, which is GDP, also reduces. So end of the day, the central banks of various countries has to pitch in and reduce this inflation. So how they reduce the inflation? They increase the interest rates. So if they increase the interest rates, people are unable to spend more because their cost of borrowing increases. So cost of borrowing increases means they will not get cheaper money. So not only that, if the interest rates are high, say if I am having a home loan, so the home loan interest rates also increases, so my EMIs also will increase, so that will also impact me. So I will not be able to spend more, because already I have to spend more for my home loans and other things. Also, if you see from a company perspective, if a company is running a business, majority of the companies run the businesses with some amount of debt levels. So this debt is again a borrowing from a third party. Borrowing interest rate increases, the cost of borrowing also increases. So this will end of the day eventually affect their profit margin, because as the business is serviced by debt, and if the interest rate is high, so that much percent, say 1% increase in interest rate means 1% cut in the profit margin, because that much is to be given back as an interest of the borrowing. As a result of Fed hiking interest rate recently in almost every month in US, the GDP growth has been impacted, and end of the day the recession has hit the country. So because of this, loss of productivity has led to a sharp fall in GDP quarter on quarter in US, and in that case in many countries, and this has led to recession in these countries. So if you ask me, recession has already hit the US because of this negative GDP growth, and as I mentioned, US being a mother market, all the other countries are also impacted by these effects of recession. Now the $1 billion question: is it really a recession now? Stock market worldwide is so much volatile. FIIs, the foreign institutional investors, has been continuously selling in all the other markets, including the mother market US. So regarding FII selling, I have already covered that topic in depth in my last session. So if you have not watched that video, you can definitely go and watch that, which will really help you in your investment journey. Now let's look at our index Nifty 50, the Indian index Nifty 50. So on the screen you can see, in this year 2022, there has been three major falls. So it has touched up to 18,300 levels in March and fallen to 15,700 levels. So this was during the Russia-Ukraine war in March. And again in the next month, which is April, in April the market has again formed a V-shaped recovery, touched 17,400, and again there was inflationary problems. So because of this inflation, US Fed and even RBI of India, which are the central banks of respective countries, also increased the interest rates. So based on this interest rate hike, again there was a deep fall from 17,400 levels to 15,700 levels again. Again there was a V-shaped recovery. So then market touched 16,700 levels, which was in June. So 16,700 to 16,800 it has touched, and from there again, based on the second Fed rate hike, and even RBI also increased the interest rate, so again there was a fall from 16,500 levels to 15,200 levels. So there was a steep fall, and every fall there has been a reduction in the height of each curve. And if you see, the curve is continuously seeing different bottoms, like 15,700, 15,200, or maybe going forward in end of July also, based on the inflation data, Fed can again increase the interest rate by 75 basis point, which is like 0.75%. So India can also follow the track. So again 0.7% interest rate hike means we can again expect a negative sentiment in the stock market, and again they can sell off, and maybe instead of 15,200 levels in Nifty, it can see as low as 14,000 as well. So we cannot actually predict those levels, but I am just trying to tell you the trend is negative as of now, and though there is slight bullishness in between, we can see that the market is eventually going down. So this is quite obvious in a inflationary scenario, and government is trying to bring down the inflation by increasing interest rates, and also trying to soft land the economic slowdown. As you all must have read in newspapers and other articles that the inflation in US has reached its highest level since the past 40 years. So that is huge. So many of the countries worldwide has similar scenarios, not only just US. So again, as I mentioned, the interest rates are being hiked, and again going forward it is expected to be hiked much higher. So this higher interest rate again will lead to higher cost of borrowing, so lesser spending and also lesser profitability by companies. So the earnings of the companies goes down, the spending of the common mob goes down, so productivity in the industry or in the economy goes down. There will be lesser consumption, so lesser productivity, lesser profitability. So end of the day, the gross domestic production rate also goes down, so the GDP keeps on decreasing. So that is how we have a negative GDP quarter on quarter on quarter, so again leading to a deeper recession. But end of the day, as we already mentioned, the bank is doing this interest rate hike to suck in all the liquidity from the market so that the inflations are arrested. But always central bank find a fine balance in between the inflation and the recession, or in that case the economic slowdown. So there should be a balance in between these so that they balance the economic growth and doesn't impact the growth of the economy in a higher level. But definitely inflation going high is much dangerous. So what they are doing currently, which is increasing the interest rate, is the best way of soft landing the scenario. As you know, the productivity decreases, the company doesn't produce more, so company will be under margin pressure. So to generate profit, they will have to find ways of cutting down the expenses. So first way is by laying off the employees. So many times good companies lay off only non-productive or lesser productive employees, so they will be the first to face the heat, and then later on if they are unable to control the scenario, then even the good performing employees may also be laid off. So there will be high rate of unemployment in the scenario. So unemployment again leads to lesser salary or lesser income. So lesser income means lesser spending. So again productivity is impacted. So it's a large cycle. So this cycle is already explained by me in how the economy works in part 1, 2, 3 in my earlier sessions in the value investing series. If you have not seen that, I suggest you to go there and see that in detail so that you get the entire concept clear. So from all this, it is very clear that recession is here, and the recession is not going to just fly off so soon. So in this year, as per me, at least till the end of the year, you can see the effect of inflation and you can see the effect of recession. So as the inflation goes down and as the economy slows down because of this interest rate hike, you can see heavy recession going on. I don't expect the depression to come because it may not be that long recession, but still recession will be there and markets are going to go down as per my analysis. So now coming to the fourth session of the video, should you be really bothering about the recession? So as I explained in the last session, the first thing you should be worried about is your job safe? So if you are a good contributing employee in your company and if you perform well, then I don't think that you will have a job cut. So maybe your increments are delayed, maybe you don't get an increment for consecutive 2 years, but still if you have the job saved, then it's a good thing and you have a steady income. So as a normal employee, you don't have to worry. Now talking about the investments, especially the stocks, as I mentioned, the cost of borrowing increases. If it's a debt-free company, the scenario is different, but again the productivity is affecting a debt-free company as well. So talking about a company with debt, so they also have a heavier impact than a debt-free company. So they have higher cost of borrowing, which will impact their profitability. Profitability impact means your earnings goes down. So earnings goes down means the price to earnings ratio, which is the PE ratio, increases. So if the price is there to stay and earnings goes down, the valuations will seem high. Like the FIS are selling all the high PE stocks because the valuations are so high because of the earnings drop. Because of these higher valuations, there can be a heavy sell-off in the market. We have already witnessed heavy selling, and further going forward also some more selling can be expected. And even strong fundamental companies who are having higher valuations can also go down. So this is normal in the market if there is a recession. If you see in Indian market, or in that case in US market or other countries also, many of the stocks has reached their 52-week low or even below that. So though you are invested in quality stocks, those stocks also would have come down, because this is mainly based on a macroeconomic event. This is not a microeconomic event. So all the stocks are bound to go down. But as we are all value investors, we would have entered. I hope that you also would have entered at a lower valuations. So lower valuations means already we are invested at a much lower rate than current rates. So we are still sitting on profit. So 52-week low means the all the profits which was made in last 1 to 2 years is completely wiped off. So this is quite normal. The valuations has come down so low. So many of the companies, attractive companies with beautiful businesses, are available at a very cheap valuation at the current scenario. Now coming back into the last session and most important session of the video, which is what you should be doing on your investments, on your stock portfolio. As we are all value investors, and I believe that all my subscribers or the viewers are following my value investing style. So we have already entered the various stocks, good quality businesses, at a much lower valuations. So we are not, or we should not be bothered about the valuations as such. But as many of the stocks have come down to a much lower valuations, if the stocks which you hold in your portfolio, or those are in your watch list, which are quality businesses with low debt, with quality management, with great economic modes, and with good corporate governance, and low debt to equity levels, and other good valuation criteria which we have already mentioned in my previous sessions. So if all those criteria, those companies are available at a cheaper valuation, I strongly suggest you enter in a staggered way into this market. So again, the market can fall further from here. We cannot time it. Maybe it can go up as well. So don't get into the business of timing the market, but whatever cash you have, or whatever cash you have booked out from various companies which have already reached the target prices, so use that cash to invest into these quality businesses which are available at a cheaper valuation. And also I am sure that in my earlier video on bonds I have mentioned that you can remain in cash through bond funds or bonds as such. And if such scenarios of recession or economic slowdown happens, where the stocks are available at a lower valuations, you can sell off your bonds, which would have fetched you a interest or a return of around 5 to 7% or even 8%. So these bonds you can sell off, because higher interest rate is going to reduce the bond yield, and bond funds may not perform in coming days. So bonds would have reached a higher interest rates, so you can sell off, use those cash, or you can sit on that cash in your, say, in your banking account. And once time comes, and if the stocks are available at a cheaper valuation, which many are now also, you can invest in them in a staggered way. So such strong companies in a longer run are bound to come back with a bang, and they are supposed to give you multi-bagger returns. So many of the stocks, if you see, have reached or eroded their capital up to 50 to 70%. So these are all available at cheaper valuations. So if the business is strong, the earnings are bound to come back, and if the earnings grow and the price is there, so price to earnings, price to book value, all these things are going to be attractive going forward. So this will multiply your money over a period of time. So if you have these companies in your watch list which you wanted to enter but were having higher valuation, which now is available at a cheaper valuation, definitely you can enter into those. And those which you are already having a portfolio wherein the stocks are already at a lower price, you can average those stocks. So don't try to get into penny stocks or new stocks, like you don't know what business they are into. So don't invest in that. Be in your circle of competence. Invest in those companies which you already are aware of, in which you have already invested in. Average those investments. So this is the best time to do that. So again, as I mentioned, if the market falls from here, already you have done a staggered investment. Say if you have 10 lakhs, invest your 3 lakhs currently. You still have rest of the 7 lakhs with you. Now market may go down further, so invest another 3 lakhs, and it can further go down, so another 3 lakhs. So like that you can invest in a staggered way. And if the market goes up, then remain in cash. It's not a problem. You always get another opportunity to invest in. I have even heard, or even my friends are taking loans on a lower interest rate and investing that money into stock market. So if you are confident that your stock market returns are higher than the cost of capital, which is the loan amount. Say if you are taking the loan at a 9% interest, and if you are getting a 15% or 18% return from the stock market, you can definitely go for that as well. So people would say that going on a debt and investing on a stock market is risky, but if you are very clear about the fundamentals of the stocks and its potential going forward, so you can definitely do that. If you don't have excess liquidity, you can do these things also, like going for a loan and taking the money remaining in cash, and once the time comes you can invest, and definitely it will help you repay the loans and also bring in profit as well. So that is like a free money. So to conclude, recession is good for a value investor. You are getting the stocks at a much cheaper valuation. Consider this only as an opportunity. I know that many of your portfolios has gone down so much, so you don't have to worry about that. So even during your pandemic, your stock portfolio would have gone much lower. So these stocks are bound to come back, which you have already seen post the economic slowdown during, or the recession during the COVID pandemic. So that was a quicker return, like in 2 months it bounced back. But this time this may not be the case. It would take some 6 to 7 months as well. But be a patient investor, stay put, stay long. You will definitely make money in the market. Again, regarding traders, if you are doing trading, it is so much risky, especially options trading and other hedge methods. So I suggest, if you are a trader, especially the video is not for you, and traders should not be doing trading as per me. Investing is the best way of making money in the market in a longer term, in a most realistic way. So all the value investors, stay invested. Don't go into the panic mode of selling off all your stocks. Stay invested, stay happy. Happy investing.